What if I told you that Warren Buffett didn't get rich by picking stocks? What if the truth is he never even cared about the stock market the way that you think he did? Because the real story is Buffett didn't just invest in companies. He was buying control and then getting paid whether the market went up, down, or sideways. And while the rest of the world was obsessed over finding the next big thing, Warren Buffett just kept making money without ever needing the market to help him. So what was the real secret? How did this 11-year-old kid from Omaha, Nebraska build the world's most powerful financial empire? And what can you take from his playbook to start building your own wealth today? Well, in this video, we're going way deeper than the surface level stories you've heard before, beyond the myths, and I'm showing you exactly how Warren Buffett built his fortune, the strategies he used, the deals he made, and the 3 timeless principles that'll change how you look at investing forever. This isn't the Warren Buffett you've been told about. This is the Warren Buffett you don't know, and the lessons that can transform your entire approach to investing. For those of you who are new to the channel, my name is Danny Gould. I'm the CEO of Gould Capital, and over the last decade, I've overseen over $250 million worth of real estate transactions, as well as co-managed a $300 million hotel portfolio. And in that time, I've had the opportunity to interface with dozens of ultra high net worth investors, billionaires, leaders of some of the most prestigious family offices, but none of those people quite stack up to Warren Buffett.
Warren Buffett. It's the sound of money.
Billionaire investor Warren Buffett, the second richest man in America.
He's estimated to be worth about $62 billion. It makes him the richest man in the world.
And so a couple of years ago, I made it my mission to learn more about Warren Buffett and understand exactly how this man thinks. And this video is the culmination of all of that research. Be sure to stick around till the end of the video where I share with you the 3 greatest lessons that I have learned from Warren Buffett and how you can apply it to your own investing journey. So let's get started. Warren Buffett was born in 1930 in the middle of the Great Depression, and his father, Howard, was a stockbroker. But as you can imagine, when the market crashed, Warren's dad lost his job, and his family had to adapt fast. Money was tight, meals were few and far between, and Warren saw early how fragile financial security could be. And this early exposure to financial fragility created an obsession within Warren. And while most kids were outside playing ball, Warren was inside reading stock tables. Not because someone told him to, but because he was obsessed with this from an early age. Now, business was obviously Warren's sport from an early age. Now, not only that, but Warren clearly exhibited an entrepreneurial spirit pretty early on. At only 6 years old, he was buying gum by the pack and selling it door to door. At 7, Warren moved on to Coca-Cola, buying 6-packs from his grandfather's grocery store and then reselling the bottles individually for a small markup. He was flipping Coke bottles at an early age. It wasn't flashy, but it worked, and it taught him the very first principle of business and investing, which is you don't need a lot of capital to start. You just need to understand market. At 11, Warren Buffett made his first real investment. 3 shares of Citi's Service Preferred, $38 a share. Now, when the price dropped to $27 a share, Warren panicked. So when the stock eventually rebounded to $40 a share, he sold. The stock kept rising, and he ended up missing out on hundreds of dollars of appreciation over the following years. Now, Warren talks about this lesson a lot. This is a mistake that stuck with him forever, and it's not like he was upset about the hundreds of dollars, but he was upset that fear made the decision for him. And this was the beginning of a core Warren Buffett investing principle. You do not let emotion drive your portfolio. Now, by the time high school rolled around, Warren wasn't flipping burgers. He was buying cash-flowing assets, starting with pinball machines. Warren purchased used pinball machines for $25 each and placed them in local barbershops. He then split the revenue with the owners. The model was simple: 1 machine, 1-time setup costs, and the money came in while he slept. And in less than a year, he sold that small business for over $1,000. Now, in today's dollars, that's nearly $25,000. And by the time Warren Buffett turned 17, he'd saved more than $5,000, which adjusted for inflation is over $60,000. One thing to note that's quite surprising is that Warren Buffett was rejected from Harvard, but he didn't let that deter him. He was accepted and enrolled into Columbia, where his investing hero, Benjamin Graham, was teaching. Benjamin was a legendary investing author, having written several investment books in the mid-1900s, including The Intelligent Investor. Graham's message was simple: invest in value, not hype. In other words, a bird in the hand is worth 2 in the bush. And this investing philosophy shaped every decision Buffett would make from that point forward. By the time he was 26, Buffett had already built up more money than most people retire on, but he wasn't done, because for him, it was never just about the dollars. It was about the process, the principles, and building something that could compound over decades. After Columbia, instead of heading down the street to Wall Street, Warren went back Omaha, Nebraska. And in a tiny little corner of his house, he launched what would become the foundation of his empire. He called it a partnership. But today, what Warren built is commonly known or referred to as a hedge fund. He raised a little over $100,000 from people who trusted family, friends, and a few business contacts. He called it Buffett Associates Limited, and he put in just $100 of his own money into the fund. Now, what made this fund different was how he structured the performance fees. He took zero upfront fees, but collected 25% of the fund's profits above a 6% preferred return to his investors. This type of structure shows that Warren was really a long-term thinker, and not only that, but he was willing to bet on himself, and it worked. From 1957 to 1969, the Buffett partnership beat the market every single year. And while the Dow Jones returned around 7%, Buffett was compounding at more than 20% annually. But here's what most people miss when they talk about Warren Buffett's early success. He didn't just build wealth trading for himself. He was managing capital for others and earning performance fees, reinvesting aggressively, and scaling with discipline. It was a business that gave him leverage without borrowing a dime. Now, the image that most people have of Buffett is the solo investor, reading annual reports and newspapers in isolation, but in reality, his first big leap was through managing other people's money. And that's what gave him the traction to start building a long-term investment vehicle that could one day own entire companies outright. In the early 1960s, Buffett came across a company called Berkshire Hathaway, and on paper, it looked like a classic Benjamin Graham play. The stock was cheap and it was trading well below the cash value of the business, but the business was shrinking. But the assets on the balance sheet were worth more than the stock price. So Buffett started buying shares slowly and quietly, not because he believed in textiles, but because he believed in the principles that Benjamin Graham had taught him. And after a few years, Warren held a sizable position. Now, in 1964, Berkshire Hathaway offered to buy back his shares at $11.50, which would have made Warren a small profit, and he agreed. But when the formal offer came through, it was only for $11.37.50. Now, sure, it was only 12.5 cents less, but to Buffett, it wasn't about the money. It was about trust, and he felt like he was being played. So instead of walking away, he doubled down. He started buying even more shares, this time with the goal of taking control. Now, within months, Buffett had control of the entire company. And now he had a problem because he owned a dying textile business, which is something he never wanted in the first place. For years, he tried to make it work. He kept the mill open, tried to reinvest, but the economics never improved. The textile industry was moving overseas, and the writing was on the wall. It was, by his own admission, the very worst investment decision of his life, but it also forced him to build a new kind of vehicle, one that didn't flip stocks, one that could buy, hold, and operate entire businesses indefinitely. He turned Berkshire Hathaway from a broken factory into a financial fortress, a legal shell that could absorb cash flowing businesses and never let them go. That mistake, the overreaction to a lowball offer, accidentally gave Buffett the tool that he needed to build the greatest long-term compounding machine in financial history. Now, guys, Warren still admits to this day that Berkshire Hathaway was the very worst investment decision that he ever made. And this is a part of the story that I really love for a couple of reasons. First of all, it's super relatable because how many times have you ever made a mistake, sworn that you would never make the same mistake again, only to let emotions get the best of you and repeat the very same mistake again? Warren had sworn to never let emotions get the best of him after liquidating, panic selling that City Service preferred stock, but he ended up making that same mistake again, which led to his hostile takeover of Berkshire Hathaway. And I also love this story because this mistake ended up being a blessing in disguise. Sometimes we make mistakes, but Warren was able to make the most of it, and that's a lesson that we can all learn from. Eventually, Buffett's strategy of buying distressed companies hit a ceiling. It was no longer scalable. Buying distressed companies required constant turnover, constant monitoring, and frankly, it was just a big mess. And that's when he met Charlie Munger, a lawyer by training and a thinker by design. And Munger told him something Buffett had never fully considered. It's better to buy a great business at a fair price than a fair business at a great price. This wasn't just a stylistic tweak, it was a philosophical overhaul. Munger pushed Buffett to raise his standards, not just for price, but for quality. So in 1972, Buffett and Munger bought See's Candies for $25 million. It wasn't a distressed asset, it wasn't cheap on paper, but it had pricing power, loyal customers, and he didn't need constant reinvestment. Over the following decades, See's produced more than $2 billion in profit. That is an 80x multiple, and they barely had to touch it. This investment changed everything for Buffett. After See's, Buffett stopped chasing deals that needed fixing and started buying companies that just needed time. Think Coca-Cola, think Geico, think Apple. These weren't flips, they were cash machines. and he realized that a great business with pricing power, strong brand loyalty, and a simple product could outperform a cheap stock with a broken model. This was the real shift. Buffett stopped looking for stocks to flip and started looking for cash machines that he never had to touch. And by the early 1980s, he wasn't just an investor anymore. He was a capital allocator, choosing where money should go, how long it should stay, and what it should earn. But there was still one piece of the puzzle that was missing, a source of capital he could control without having to take on debt. And when he found it, he unlocked the Pandora's box of scaling. By the mid-1970s, Warren Buffett had already made a big name for himself, but behind the scenes, he was studying a business model that would quietly supercharge his wealth for decades to come: insurance. Here's what Buffett realized. Insurance companies collect premiums up front, but they don't have to pay out claims right away. That gap between when the money comes in and when it's paid out is called float. And that float doesn't just have to sit there, it can be invested. And as long as the insurance company is well run, that float becomes something magical, a giant pool of low to no cost capital that Buffett could deploy anywhere he wanted. Now, Geico had something that most insurers didn't, a direct-to-consumer model. No agent commissions, lower overhead, strong underwriting discipline. Warren knew it could throw off float faster and cheaper than almost any other competitor. And here's the key: profits from those float-funded investments didn't belong to Geico customers, they belonged to Berkshire Hathaway. Buffett realized he could use float to buy great companies without selling stocks, without issuing debt, and without using Berkshire's cash reserves. It's how he bought companies like Coca-Cola, American Express, and later on down the road, Apple, with money that he technically didn't own, but fully controlled. Warren Buffett didn't just create wealth. He engineered a financial empire that others couldn't even imagine. While the world was focused on quick wins, he was patiently mastering the game from inside out, using strategy, structure, and patience to stay one step ahead. Now, this is just the beginning of how Warren Buffett built one of the greatest financial machines in history, and there's so much more to uncover. So if you've made it this far in the video and you haven't done it already, make sure to hit that subscribe button and hit the notification bell so that you don't miss part 2, which is dropping next week, where we'll dive into the pivotal moments that changed the course of Warren Buffett's empire, starting how he hit the gas pedal when the market was burning down. Part 2 drops next week, and trust me, you don't want to miss it. This is Danny Gould, everyone, with your investing secrets. Catch y'all in the next video.